Hello and welcome to this Markets Today special. I'm Udayan Mukherjee. With me is Abha Bakaya, and we've got a special guest for you today, Prashant Jain, who for decades ran HDFC Mutual Fund's equity desk very successfully and now retired, but still very much a very close observer of the markets. Prashant, it's great to have you on the show today. You've been somebody who's always had a keen eye on value and valuations. Given that, if you were a hands-on fund manager today, would you be cautious about the environment and where valuations are, or would you be optimistic?
So there I am quite positive on the economic outlook of India, but I think the risk reward is evenly balanced in the near term. These are markets that are fairly valued, and we have prospects or we have rising cost of capital. So I would say near term outlook, uh, I would not, I mean, it's hard to forecast, but risk reward is balanced. But longer term, returns are driven more by growth. And I think the economic outlook of India is probably the best that one has seen in the last many decades. And that's what makes one optimistic over the long term.
Uh, in your career, investing career, Prashant, when you've had moments like this where valuation multiples generally for the market are around 20 and we've got a rising cost of capital, uh, have people had to be patient for returns, maybe wait 2, 3 years at least before the returns come in, median returns? Or would you say that the markets have surprised? I mean, what has been your experience?
So, Udayan, I don't think, past experience of such instances will help because these are not valuations where things are setting at an extreme. And what's a 20 PE can also become 22 or 24 PE. And let us not forget that the earnings growth in India is likely to be in low to mid teens. So I think these are reasonable markets, I would say. If you have patient capital, if you have 3 5 year view, debt equity should still outperform bonds by 3 to 5% a year. But I don't think past, similar situations would be able to guide us as to what will happen next year or so. And in any case, in last few decades, we have not seen the cost of capital rising in the West as it is now.
Uh, you know, leave the broader market aside and let me ask you about one segment of the market where there is a lot of news flow these days because of locked in stock coming in and creating a lot of turbulence and volatility in these digital new age companies. How did you approach it in the last few years of your investing career at HDFC Mutual Fund, these digital new age stocks? And given that they have corrected significantly, if you were to manage money today, how much would you allocate to these?
So there to answer this is extremely difficult because these are very diverse set of businesses. But let me share with you some thoughts around this. See, I think the excesses in this space were caused by the rapid adoption of digital in COVID times and also the sharp collapse in cost of capital due to COVID. And that is what I think created this excess in this space. And I think both these factors are now reversing. And that's why we have seen significant corrections in this space. And I think these are very diverse business models. And in many cases, even the route to profitability is yet to get established. So I, for most of my career, have avoided business models that are not well established because I feel if you invest in such businesses, either you get in very early, which is not possible in the public market space, and by the time these models come to public, if they are not established, it's very hard to value them, and the risk reward is not favorable.
Fair enough. You're clearly looking at that risk reward ratio being far more palatable at a time like this, Prashant. But I want to get your view in that context on PSU banks. It's pocket that you've always tracked so closely. You've been known for your calls on some of these names. Where do you stand now when it comes to PSU banking names and the kind of potential for return that we could see? We've had a phenomenal set of earnings coming through, but given the backdrop against which the economy is moving right now.
So I think just like in private sector, there are good and bad PSUs, and I don't think we should paint all PSUs in one brush. And I've been careful to invest only in sustainable businesses, both in private and public sector. And if you look at the good banks in the public sector, I think they are now trading close to one-time book. If you think 1 year, 1.5 years ahead.
Sure.
Which I think there is still some upside left in terms of valuations catch up. And I also feel that the outlook for earnings growth in banking is quite strong because credit growth is good, balance sheets are clean, provisioning costs are likely to be low. But these are not offering deep value in general. And as I said earlier, these are markets where bulk of the returns should come from growth, the business growth, the nominal GDP growth, and there is not much returns to my mind in general terms from change in valuations.
Speaking of PSUs, Prashant, the another basket which has done very well over the last few months is defense. I mean, I remember there was a lot of excitement around defense as a sector back in 2014 when this government first came into power, and again in 2019. But those did not actually play through because the earnings and growth never sort of came through in the way the market was expecting. Do you think this time it is different? Defense is actually a sector worth betting on?
So then again, I think you have seen almost a 3x rise in prices in most of these companies. And in my earlier stint, we were reasonable investors in many of these names. But the price movement has been quite sharp. These are good businesses, very sustainable, with strong competitive advantages, with large order backlogs, with a lot of growth ahead of them. So I think these are growing companies, but again I would say defense generally the delivery schedules are quite elongated. I mean, to deliver an aircraft it takes years. So I think these are companies that should exhibit growth. It will not be linear growth though. It may be low in some years, it could be healthy in some years. So I would again come back and say these are multiples that are close to fair to my mind. Though, I mean, if you compare this with the private sector engineering companies, it is still quite low. I feel PSUs will throw up good companies once in a while, but to expect them to turn to be exceptional companies is less likely. And therefore, I am not very comfortable with valuing these companies at much higher multiples.
Okay. You made the point right now that from here on, market returns will be determined by earnings and not so much by expansion of PE multiples. Sticking to that point, how bullish are you about earnings going forward? Because we've just gone through an earnings season and it's been patchy. Some of the banks have done very well, but if you take that out, aggregate earnings, particularly in small caps and mid caps, did not seem very spectacular. Could there be room for disappointment out here, Prashant?
So then just to give you a perspective, last decade, the profits to GDP in India fell from a peak of 7% to a low of 1%. We have recovered sharply from that, and now we are running close to between 4 to 5% profits to GDP. And this fall was the result of low commodity prices, low capex, and high provisioning costs of banks. I think all of these have reversed. So to my mind, that catch up in profit growth is behind us, and going forward I would expect mid-teens kind of earnings growth in aggregate terms.
All right. You know, Prashant, lately there's been so much talk about how this is going to be India's decade, and I wanted to get your view on that. I know you've always been bullish on the story. You've always picked stocks ahead of time, betting on those cycles. Is this going to be a bull run like none other? Have we already begun on that journey? Are there chances of us faltering? What, in your mind, are the biggest risks?
No, I think the outlook, economic outlook of India is probably the best that I have seen in many decades. And the reasons for that are quite simple. If you look at the change in working age population in the key economic zones of the world, whether it is US, Europe, China, or Japan, most are experiencing negative growth in working age population. US is growing but at close to zero rates, maybe half a percent or so. It is only India where the working age population continues to grow, and that should remain that way for the next 2 to 3 decades. And this is happening at a time when work from home has become acceptable.
Yeah.
So I think what we have seen in software services, in BPO, I think will happen to a lot more services. It could be back offices, accounting, taxation, legal. I mean, all anything that can be done remotely has a chance of being outsourced or offshore to India. So this should create a fairly large number of jobs in India. On the other hand, if you look at what is happening in China, even there the working age population is now declining for last 5 to 7 years. Wage inflation in China therefore has been quite steep. Their wages, manufacturing wages in China are now almost 2x of Indian wages. I mean, they have a huge scale advantage, productivity advantage. So this does not translate to a great advantage automatically, but I think on the margin we are improving. China plus one, geopolitics, I think also favors India as at least a second alternate destination. And it is reflecting in the rising FDI inflows into India. So I think in the next decade, India should be able to grow its share of manufacturing exports faster than what we have done in the last 10 years. And manufacturing actually is a much bigger opportunity for India. And every half percent improvement in market share is almost 3 to 4% of India's GDP. So I think this has the prospects of increasing India's growth rates maybe to 7 or 8% over next 1 or 2 decades. And if you bring these two together, I think it creates an environment where we can create huge number of jobs, increase purchasing power, which should lead to higher consumption. So I feel net net that next 2 decades India should do extremely well. And finally, if you also observe, we have carried out very important reforms within the country. GST, digitization, the payments getting digitized. India is at the forefront of the digital infrastructure. The RERA, the IBC, the Make in India, the PLI, and the whole lot of social initiatives that we have taken, giving a home, bank account, gas, electricity, water, toilets to the low income households. I think if you look at all of this put together, I think it creates a very favorable economic environment for India for the years ahead.
How much of it is in the price, though, Prashant, from a market perspective? I mean, when you look at the market in a granular form today, is there any pocket of value left? Because, 2 years back, I mean, you were just talking about PSU banks, defense. A couple of years back, you could have said that they're deep value, they're ignored, and they're trading and languishing at valuations which are very tempting for medium-term investors. Can you say that about any sector in the market today?
So then, as I said, these are markets that are fairly valued in aggregate terms, and there is risk of higher oil prices, there is risk of rising cost of capital. I think with time, the impact of these will reduce or these will get priced in. So in aggregate terms, in a nutshell, I feel these are markets where risk reward will improve as time goes by. And these are not markets where you can hope to make much above nominal GDP kind of returns over the medium to long term. And these are markets where the dispersion in valuations has also come off very sharply. If you look at the deep pockets of value that were there, the banks, the defense companies, the power companies, each of these have substantially corrected. I mean, one can argue still that banking probably has a little more catch up to be done. Maybe in power there is a little more catch up to be done. But by and large, I feel there are no pockets of deep value in these markets. Value or returns will come more from growth, from patience, from compounding, and to my mind, to a much lesser extent, from multiples moving up.
I want to ask you a broader question about your investing career, Prashant, because I read in one of your what they call exit interviews when you were moving out of HDFC Mutual Fund, you said something interesting that most of the errors, and everybody makes mistakes in their investing career, were errors of commission, or omission rather than errors of commission. You did not participate in the growth stories of, say, a Bajaj Finance or an Asian Paints or an Eicher Motors. If I could ask you, I mean, you've had plenty of time to reflect on those, I'm sure. What were the reasons why you passed up on those opportunities? I mean, did you read the business model wrong, or was it concerns about excessive valuations which kept you away?
No, there, as you rightly said, I have thought about these many a times, and I think, I mean, it was most of the time the concern was around the growth, and in many cases, the companies have outperformed what I thought was reasonable to expect. And given my expectations of growth, I found the valuations to be reasonable, and that's why I passed these opportunities. And one lesson that I have learned is that when you are faced with a really high quality company, it is not just the present that will grow, but a good company, a great management can also add new businesses, new opportunities might come along. And that is what leads to your growth expectations getting surpassed. And therefore, I feel to pay a little more or even a little more than a little more for good quality, high quality companies, I think makes sense.
Fair enough. Prashant, your advice for investors right now when they're building their personal portfolios, anything that you could share with them that would help, especially as they navigate these novel times?
No, I think my advice has been the same that equities reward patience more than intelligence. And patience in equities gives you great returns because that is what is the result of compounding. India's prospects of economic growth are probably the best that I have seen. But these are not markets where one should probably invest up to your full capacity in equities. I think some money should be kept on the side, some equity capital, which probably one should wait for a little price or some time correction before you get fully invested. And in the 6 9 months, I think some of the uncertainties around cost of capital, maybe an oil price, I think these should also get settled one way or the other. And Udayan, a small correction, I am moved on from HDFC, but I am in the process of setting up a investment firm of my own. So I will hang up my boots, but maybe in some due course of time.
No, Prashant. That was indeed my next question to you. What your next? I've kept it for the last. Uh, I wanted to ask you what your next innings is looking like. I mean, is it going to be managing domestic capital? Is it going to be managing foreign capital? Is it listed in the listed universe, or are you going the private equity way? Share whatever you can about the next innings.
No, then I want to play to my strength. I've spent 3 decades in listed equities, and that's whatever I do, whether it is domestic capital, and over time, maybe, I mean, I'm not sure if I can manage to raise some capital outside. It will be for primarily following the same strategy what I have done in my earlier stints. And I'm planning to set up an AIF stroke PMS platform.
Great. Wish you great luck with that, Prashant. I'm sure you'll be very successful given your track record, and I'm sure a lot of domestic investors who've benefited uh, being in your house and under your stewardship will look at your PMS and AIF offerings. We wish you all the best, and thank you very much for your time today.
Thank you so much. My pleasure. Thank you.
If you like the video, do like, comment, share and subscribe.